Hello, well, GM, everybody, and welcome to a brand new show with Sentora. I'm joined here today by Anthony. Anthony, I'll throw the mic straight over to you. How's it going? Are you excited for the show today?
Uh, Thanks, Jack. Really appreciate it. Yeah, I'm excited for the show. I'm excited for the market. And that might sound a little bit counterintuitive based on what we've seen. I think I feel like we've hit a bottom in a lot of different ways. One of the we talked about prices. Everyone looks at prices, but funding rates based on the CDOR index, which is an average borrow rate on Aave over the last 5 years, is at the absolute lows, even what we saw in the summer of 23. So I feel like a lot of things are on a base. We're trending sideways, and typical trading is the longer you stay sideways on a base, the bigger the growth trajectory can be once we break that cycle.
Yeah, and look, today we're going straight into the origin story, and I love that you've started with immediately just top of your mind, which is the
Yeah,
market.
yeah,
Like that's
yeah.
it just tells me everything I need to know
Bad
about you.
habits are hard to shake. Yeah,
No, great habits. I love that. It tells me everything I need to know about you and the audience too. But yeah, we journey to 1.5 billion TVL is the title of this one,
yeah.
which again says everything about it. But before we do get into Sentora, I would love to know a little bit about you as well. So can you tell me your
Yeah,
background? We were just talking offline about you spent some
yeah,
time in the UK. Tell me a
yeah.
little bit about you.
Yeah. So I started my career on Wall Street. I was a short-term interest rate trader. So like think about like T-bills and treasuries and swaps
Mm.
at UBS, and then I in 2007 got the opportunity to trade Fannie and Freddie right before the global financial crisis. So got thrown right in the fire there. That was fun. And then kind of like progressed through UBS. I was trading European peripherals during the Euro crisis. So um, then in 2012, I moved to Barclays. So got to spend a lot of time in the UK. And there I became the global head of emerging markets. So I was running rates and FX trading. I got to travel around the world in that job. And then finally in 2018, I moved to HSBC to run Latin America. So all the local markets trading from Uruguay all the way up to Mexico. So that was really fun. Long flights, but same time zone, which was much better than short flights and long time zones. So, but it's really where I understood why DeFi mattered, why having access to Bitcoin, having access to stable coins. I use this anecdote that I was on the ground in Argentina in 2019 when the capital controls got put in. I was physically bidding on the Letes auction, which is the T-bills that
Mm.
failed, and knew immediately that we're going into capital controls. You got to understand if you talk about a currency that had 200% inflation. Like I'll give you an example. When I started in HSBC in 2018, dollar peso was 12 to 1.
Yeah.
It's now in the over 1,000 to 1. So just think about the wealth destruction that happens there. Now the other thing you have to keep in mind is because of the volatility of FX, you can't buy foreign cars in pesos. You have to buy them in dollars, and you typically can't buy real estate in throughout Latin America unless you have dollars. So think about being your middle 30s, you're hitting your stride on your earnings, and you have no way to get dollars, which means you have no way to store wealth, right? Because real estate is the only way you can store wealth in most Latin American countries and most emerging market countries, but it trades in dollars, and you're not allowed to have those. So that was kind of a remarkable experience for me. And then I moved to Coinbase, built a DeFi and derivative trading team for Coinbase. Got to hire some of my old friends from Barclays to join, and then started Trident, which you see the relic in the background. Started Trident, doing mostly structuring and lending there, and then we decided to merge with Into the Block, which is a on-chain a smart contract asset manager risk and analytics platform, which I was a client of at Coinbase. So it's like the hair club for men. I'm not only the CEO, I'm a client. Um, and we merged, closed our Series A in April, and have been building ever since.
Wow, that I love the South America sort of context there because you're right. Like so many people won't know that. I think I actually saw Brian from Coinbase mention this the other day. U.S. residents, UK residents as well. We don't understand this idea of like ownership or wealth retention we see inflation at maybe 10% and lose our minds when our careers don't quite follow that same trajectory and keep up with inflation. Imagine that, 10 to 1000, and yeah, not even being able to use that currency that does just have a more stable rate to it, like we can in the US and the UK. I experienced that. I was in Southeast Asia for a little while, and when I was traveling places like Cambodia, though I think whilst I was there, they experienced a coup. You just couldn't use the local currency. Nobody would take it. You literally had to use dollars. And we'd been traveling Southeast Asia for a while, and just to access dollars, the markup was ridiculous, because you're on the ground trying to make these changes. And yeah, look, this is one of a number of problems as to what has made me realize how fundamental crypto ramps are when you take a global position, when you look at it from a global lens instead of maybe the fortune that you have, maybe residing in a country where it doesn't always have those problems. Got a lot of friends from Lebanon, they got debanked a couple, I think it was like 5 or so years ago now. A lot of the people pushing this space forward come with that type of experience. But yeah, I think globally it's fundamental in
I
so many
mean, I
different
mean,
ways.
we have extreme privilege living in the G10,
Yes.
that our currency is actually worth something. I don't think we necessarily appreciate the privilege that we have.
Yeah.
Right. I'll give you one other. Go look at a chart for the Japanese yen over the last 3 years.
Yeah.
That is EM type of destruction, right? You go from 100, 120 yen to the dollar to 150, 160 to the dollar, right? That's the
How do you
second, third
operate?
largest economy in the world.
Yeah, I don't know how you would operate. Your business, especially if there was global, transport, if you were picking up materials from anywhere else, how are you ever going to factor in those costs or those type of changes? It's wild to think about.
Especially when energy needs to be imported and is priced in dollars.
Exactly. Yeah, yeah. And there's so many other like tiny variables that include that sort of asset, like silver, like copper, like things that will go into your materials, all of these things that transport globally. Yeah, it is great context, honestly, Anthony, to start the show there. And yeah, I saw Brian reference this. I think it was literally today on Coinbase talking about like how US really don't appreciate like how valuable it is to have an asset class and a currency like this. Tell me where you went then from the UK side. So you did a lot of traveling. You got to Trident. You mentioned that the absorption bit. Tell me sort of a little bit more about that journey, the Trident, and then coming into the block and everything that happened there.
Yeah. So Jesus Rodriguez, my co-founder and the CEO of Into the Block, we really built a strong relationship when we were a client at Coinbase. One of the events I remember very vividly is we had a decent sized position in UST, so Terra Luna's stablecoin, and we worked together quite diligently we identified the risk, but the yields were so high to pass up on. So we worked together to build a construct that, in the case of the depegging event, we would exit our positions very quickly. So we set a depeg at 98 and a half. So if it ever hit, and his technology was able to monitor block by block, and if any of the risk triggers that we embedded within the smart contract hit, it would just disassemble the trade. It would sit in my wallet. And yeah, we exited. The fall was pretty dramatic once it hit 98 and a half. So we ended up exiting at 96 and change. But we exited so early, we were able to put counter positions on in perps on FTX. So, from which could have been a catastrophic loss turned into a small gain. And you never really know how good the technology is when it's claiming to be risk management until you live through a crisis.
Yes.
Right. So that, at that point, and I've done risk management my whole life. So seeing that in action was just incredible. And then, when we raised money for Trident, Jesus introduced three of our four investors. And we seemed to be talking every day, working together, building products, because we had two kind of symbiotic businesses with very little overlap. And we were starting to pitch certain projects together. and Jesus came up with the idea and said, "Hey, why don't we merge the companies and you become the CEO?" Right? And if you look at Jesus's background, that was extremely humbling for me. Distinguished engineer at Microsoft, DRW, incubated multiple companies, multiple exits. But I think the synergies is what makes Sentora very different, because we have a combination of, on one end of the spectrum, a PhD electrical engineer who writes financial textbooks, teaches at NYU, started Brevin Howard US as the COO, built volatility technology, sold to Morgan Stanley and RBS, like very accomplished TradFi type person, to Jesus was a distinguished engineer at Microsoft, started AI programs, started cloud programs, built deep smart contract analytics, and then asset management contracts. So the combination across the piece is pretty amazing. And what makes me so proud of us on tour is that we can engage very TradFi clients and very DeFi focused clients all within the same talent group.
That's a that's a CV I haven't heard before. Like between you, the Coinbase experience as well, and just the way that's all been built. I can imagine that conversation, and why don't you take over this? Why don't you become the CEO? And how how that must have hit you initially. Obviously, it was a good move. Sentora, we mentioned at the start of the show, scaled to 1.4 billion TVL. It took around 5 to 6 months. Tell me about that journey then. Tell me, the strategies, the moments, like what were the decisions that you, the team, and
Yeah.
the founders made.
So while it looks like we started in October, we had really started much earlier than that.
Yeah.
One of the challenges we identified with vault curation was there was just an unrealistic expectation initially. So, people were looking at the vault curator to protect their money, but doing none of their own research on what assets are in the mix. And basically, we're just getting attracted to high yields. And that kind of perpetuated into adding the highest yielding, but potentially scam assets as fast as possible to basically get the TVL. And we've monitored the situation for quite a while and felt like we didn't have an edge there. Our whole mantra is return of capital before return on capital. And we just, and many of these other vault curators who have done this have gotten away unscathed. They get blamed for a little while, and then the next time they post an 8% rate, everybody files back in. So have built a Teflon type of guard around this. But it didn't meet our standards and didn't really meet our ethos, until we started doing deeper and deeper due diligence on asset selection, how much information we required. And then we actually were surprised, like teams like Maple have been very forthcoming with helping us really understand their book, giving us a visibility into that book on a very regular basis, which got us extremely comfortable growing there. We are working with the Figure team for Prime. We've done an absurd amount of due diligence. I used to trade mortgages. I really understand the process and the product quite well. I know the players. We have built pre-warning risk systems that are outside of, more looking at the market the Figure operates in than the individual token itself. And it's taken us, 4 or 5 months. So it's not something that we would ever do quickly. But I think, now that we've found our edge is finding these assets that, and we love non-correlated crypto assets, because, Athena's and Maple are such rock star assets that when yields come back to the DeFi space, we're already engaged and ready to go. So really finding those net wave of RWAs. And then, we got kind of poked a bit by our clients. They wanted to expand into Morpho and Euler, and they'd seen all the exploits from the top curators and just they felt like their brand would be tarnished if their asset was in a vault that got exploited. And that really was the kind of pushed us over the edge. But all that time we've been building different sorts of models, some of them AI driven, to identify the best opportunities, to optimize vaults, to essentially create vaults with an AI script instead of, if any of you have tried to create a vault in Morpho and Euler, it's a painstaking process, and there's multiple things that can go wrong, and you have to test it multiple times, right? So we build it into a script-based code that creates the vaults and tests them, and then optimizes the different settings on a daily basis. So we wanted to make sure we entered the market very with all of it automated, all of our risk management sound, and with a strong approach. And that's why we got in October. And I think we've been able to scale in one of the um, worst markets around.
Yeah, really. I think everybody will acknowledge that point at least. I will say you mentioned the fact that it looked like you started in October, but realistically, you started way before then with the merger, with everything that came in. Can you tell me a little bit more about the time before the merger and like what did that do for you in terms of your experience and really help you set up to what you are now?
Yeah, I think the biggest key takeaway is Into the Block had a fantastic smart contract based risk management system, right? And that was their expertise. We have 30 really talented engineers in Argentina, um, but it was very much smart contract DeFi ecosystem. And what I've learned in crises, because I traded through five or six of them, it's never the asset you're looking at um, that creates the contagion risk. It's something else that you're tangentially attached to. So it's all about the downstream effects. And it so when we took the kind of macro tradfi risk management and married it with the smart contract on chain alerting tools and risk identifiers into a symbiotic risk approach. I mean, we were all kind of blown away with the what the synergies are and what the new type of risk approach looks like. And this allows us to not only deal with purely on-chain assets, and now allows us to verify and track off-chain RWAs, which I think is key for this next wave of expansion.
Yeah, can you give me an example? So you talked about this idea that look, it's never the asset you're looking at, it's never the one that you think it's at risk. It's some small other underlying asset that somehow is connected. Give me an example of that.
Yeah.
That'd be really
So
helpful.
I'll try to pick the best one. So I'll give you a very simple one. So
Yes.
mortgages during the housing crisis was kind of like the tip of the spear, right?
Yes.
And then mortgages trade on a spread to treasuries. When that spread widens, the bonds drop in price, right? So prices are dropping, and there was points in time where in a crisis event, treasuries rally, so yields go lower. That's kind of like your protection against the end of the world scenario.
Mm,
But that got challenged a bit because Fannie and Freddie were so large, and while they didn't have an explicit guarantee, they had an implicit guarantee, right? With the market came around, and you know there were I don't this is I'm older than most people on this, but what most people don't remember is the bailout plans failed multiple times, right?
yes.
And sometimes the reaction was treasuries got sold, right? So rates would spike higher. So all of these people are piling into treasuries to hedge their mortgage position. Mortgage positions are getting crushed, and then treasuries are getting crushed, right? So like they're losing
Nowhere
money
to go.
across the board, um, and then they get pushed against their capital buffers. Then they're forced to liquidate, and then what ends up happening is the only thing you couldn't sell mortgages at that point, right? Like there was no bid. So then you sell treasuries. So like treasury rates keep rising, and no one can understand why, but because of they had to raise capital and was the only thing they could sell. So there was this period during the global financial crisis where good assets were getting smoked because it was the only thing you could sell. And then
That's
when the government came in and did the bailout, everyone got crushed in the other direction because all the spread stuff that they were selling came all the way
yeah.
back, and the treasuries went in the other direction. So that's the type of contagion. I'll give you a crypto example if that's better. So with Stream Finance, all right, we never got comfortable with Stream because of the off-chain nature of what was happening. The
Mm,
biggest concern that we had, and this is my view. I don't have any evidence of this. I don't. We're not part of the lawsuit. We had no asset exposure. But one of the things I feared about anyone doing a basis trade is auto deleveraging. And what do I mean by that? So the basis trade is relatively simple. You buy spot and you sell the future. you typically sell the future on leverage because you want to minimize your exposure to the perp deck. So like, why put 100 million bucks up against 100 million of a perp when you could put 20 million bucks and put the other 80 in a custody account, safe, earning treasury yields, right? So from a risk management perspective, you think that's a good idea. But we know in rapid moves, especially on something like a hyperliquid, the way they decide which positions to auto deleverage is the ones most in the money with the most leverage. So as on 1010, when the market collapsed, everybody who had the basis trade was short the perp. So they're laughing, right? They're happy, everything's great. But in reality, if you didn't have live monitoring block by block, second by second, what ended up happening is you got taken out of your short position, and you don't, for a period of time, you didn't realize you were no longer delta neutral, right? So your hedge is gone because you got auto delevered from the exchange, and the spot price continues to drop, right? That's what I think caused the 1010 move to be from 20% to 50% on some of these tail assets, right? Because those were the best basis trades back then. Because Bitcoin and ETH was kind of stuck in this 4, 5, 6%, and people had gone further afield looking for yield. And I think that's the main reason. I mean, unless it was a total fraud, which I can't know. Yeah. I think that's in reality what happened, right? Because that's how else could you lose half your position on a delta neutral trade? Well, that's how.
That's great context. Both pieces, I think, were fantastic context there. And yeah, look, there's sort of built within that is opportunity, right? Like in both of these versions, if you can find them, if you understand from a risk position this is happening, then you can take advantage of that. Obviously, bills, just like there's such a massive buying opportunity. If you look back to it, you knew what was going to happen, and it was just good assets being sold because yes, there was just nothing else to do. But you'd have to have that level of knowledge, experience, and insight, and understand the things that people didn't understand, like why, you know, as you said, like nobody knew why these things were being crippled, and it actually turned out it was because they were a solid asset and it was the only thing they could sell. Yeah, really, really great context here. So we're basically getting to the point where the merger hits, you know, 2025. You've got Into the Block, you've got Trident, and the nice little prop behind you to describe all of that. Tell me, what were the first moves then on this institutional DeFi layer? Like, there's a ton of stuff moving in 2025. Market's not exactly fantastic. What was the like initial approach to come in, and like how did you manage entering the space at that time with a major where there's like quite a lot of pressure to perform, right? Like two companies have just come together. There's an expectation that comes with that.
Yeah, I was actually speaking to Jesus about this morning because I mean, I've never seen a human being work like he works. I thought I worked hard until I met him. You know, he goes on vacations, which basically means he transports his whole computer to wherever location his family's hanging out at. And, you know, I've seen him put in more hours on a vacation day than I've put in myself not being on vacation. So, you know, I don't know if we give ourselves enough credit for going through a merger, closing a fundraise in a very difficult market, because Sentora is not a simple thing to look at, right? Like I think VCs really like big idea, super simple, you know, and then, you know, Series A, the other painful lesson we learned is that there's not very many growth funds. Like there's like a lot of guys who will write a check into a new layer 1, layer 2 seed round type stuff, but, you know, giving financing for growth, which just sounds counterintuitive. Like you've proven a tracker, you've proven you're profitable, you prove product market fit, but there's no money left. And, you know, most of our investors in both Into the Block and Trident had finished investing out of a singular fund. So there was no follow-on money, except for Newform, our lead, who invested in both us and Into the Block. So it was kind of thinking this was going to be kind of a no-brainer. Everyone loved the narrative, everyone saw the vision, but just didn't have the funds because of the construct of how VCs work and like trying to get into growth. So we had to merge, we had to raise, and we had to continue to do business and come up with new ideas, new initiatives. And you know, it's really impressive the resilience of the team. The integration has been, you know, nothing's ever seamless, but you know, there's no one says into the block or Trident anymore. It's all Sentora. So like that's I'm really proud of. And then be able to get all that done and finishing our first year making a good amount of revenue and turning a profit, which was, we don't ever look back because January 1st, we kind of heads down back into it. But, taking time to reflect every once in a while is probably a good habit.
Yeah, it's why I love these shows because I often get that, moment where you do get to reflect because that's sort of the question, right? People don't want to just know what you're doing now as a successful business. They want to know how you got there, and it's great to see founders and CEOs like have those recollection moments and just like, yeah,
No.
we really did we got outside the box on that one. Tell me about the vaults then, because this is something that I've heard in my time in crypto, in my time in finance for a while, is with vaults, especially in crypto when you're looking for the upside, scale seems to be the most complex thing. There's not really a ton of liquidity. Obviously, that's changing now, institutions coming in, but still, in respect to the broader financial term, liquidity is really finite here. And that means the ability to scale is sort of it's sort of shrunk to the size of the space itself and the liquidity within the space. Tell me how Sentora managed to scale so quickly with the vault products and with the business in its own right.
Yeah. So think of Centora as a kind of multifaceted financial institution, right? So on one side, you have our DeFi growth programs. That's helping stablecoins meet adoption, blockchains to grow. We're even working on a couple of blockchains that have just built smart contract layers and basically help them from the ground up: wallets, bridges, oracles, protocols, incentive programs, asset additions. So, a couple of those we're happy to announce probably next week or the week after. So we kind of, and then, winning Crack and Earn, being the first kind of earn program within an exchange that's using Centora's vault infrastructure that we built over 5 years. We kind of seeing ourselves somewhere in the middle of the intersection of capital, incentives, and yield opportunities, and vaults that want to capture all that stuff. So there's all these different layers that we kind of have our fingers plugged into, and being able to help our stablecoin issuers grow by curating vaults where they know their brand is protected, and using some of those incentives to bring that capital in, and then once that capital is in, bringing in the right mix of assets, and then optimizing. This is the hard, like building the vault's hard. Optimizing the borrow lend rate to get utility up, because the goal here is to get utilization up to 68 to 72%, right? Where it's still cheap enough to borrow, where looping trades work, and it produces a yield that's acceptable. Because incentive programs don't last forever, right? So you need to. It's good as a bootstrapping mechanism, but if you want these stable coins to be viable, usable, integral into the system, they need to be paired with the right assets, both from a safety and risk perspective, but also from a yield generation perspective, so that eventually, when incentives roll off, they can be self-sustaining. So that had a lot to do with it, and then being able to allocate from our earn programs into those vaults to capture those opportunities has been really fantastic. It's actually really hard too, because we have all the divisions we have to coordinate. So when incentives go to a pool and we're talking to LPs about deploying into that pool, and we're talking to asset issuers to increase the liquidity on DEXs so that we feel comfortable letting people leverage it. Like, there's so many moving pieces to make it work. That never really understood the complexity, but the team is, and that I think was a kind of a forcing function for us to not merge, to merge in reality as opposed to merging in principle. I've been part of multiple mergers in my career, and it's basically like you stay here and I'll stay there, and maybe one guy crosses the aisle to try to negotiate. But if we didn't mash these teams together under stress, it would never worked. And this was a great example of that.
No, look, great feedback, and I think it's really really interesting to be able to put these pieces together to where you are right now. I think a thing we've talked about right at the start was your previous background. The traditional experience. I think one of the big questions that I have right now, and I've seen the industry sort of mirror, is how traditional finance is going to incorporate into the
Yeah.
crypto space. And obviously, there's a ton of different sort of bull cases for this, or a lot of vehicles that seem to be pushing that narrative forward right now. Obviously, the markets more broadly are at risk, which means assets and like flights to safety all seem to be at risk. We've got AI in two forms having an impact on the market, at least from my perspective, which is the first form being it's disrupting everything. So where does someone put their money these days? You know, can you even trust that a company or even the S&P as a whole and just investing like you've done previously is going to have the same impact in a world where AI disrupts essentially every business within that whole group? And then you have AI in terms of crypto and traditional finance and that sort of connection that I think we've been looking for a long time, where institutions can just more comfortably come along to the crypto space because now the user experience, wallets, all of these things that have been an issue feels like they're going away very quickly with AI. You know, whether it's going to be an agent that just does all of that headache material, whether it's going to be something that is built through AI just to make it a little bit more seamless. So I guess my question to you with those both worlds as an experience, the
Yeah.
traditional world and what you're building now, how do you see institutions and that traditional finance world continuing to come into the crypto space? Do you expect more momentum now with everything that's going on, or do you think it's still going to be slower paced because of all the macro issues that we have right now?
I think so. I wrote an article about this last week.
Okay.
It's an article that says why banks should get into vol curation. So here's my headline view: asset managers or banks are going to get into vol curation in force in 2026, but I don't see them as a competitor to myself, Gauntlet, Steakhouse, or the other top curators because they're not coming in to offer leverage on Bitcoin and earn a yield, right? That's not their goal, right? I think so. Here's the two cases I see. So I'll start with banks and then I'll go to asset managers. Banks lending infrastructure has changed a lot since the global financial crisis, since Dodd-Frank was implemented, since Basel 2, 3, 3.5 coming, whatever, where the biggest change was there were so many shadow assets on the balance sheet that no one knew how to value. So what these rule changes did said, hey, we're not going to tell you what you can and can't have, but if the asset doesn't meet a certain hurdle, you have to put a massive amount of capital against it on your balance sheet. So stop people from making, because before that, Wall Street was just making money, right? Like if you worked for, when I worked for UBS, we were one of we had the cheapest access to capital. We could basically raise the treasuries and then go out and lend from everything from like AAA credit to unsecured loans and CLOs and all this other stuff. And it created these perverse incentives to continue to go out the risk curve because the trader would make the P&L, but that the bank held the bag if it all went sideways, right? And that's what Dodd-Frank did. They said, put capital up against your position. So now what banks are struggling with is, and you see it in a lot of markets, right? You see it in markets where they make a loan and they can't securitize it and sell it, right? That stays on the balance sheet. So my view is, and I've been validated pretty recently on a bunch of calls with TradFi firms, is the way I think banks are going to do is they're going to try to set their lending businesses up similar to what they do with SPVs off balance sheet, right? So typical is bank issues debt, CP, CDs, takes a liability on their balance sheet, call it 4%, lends out to a riskier asset 9%, makes a 500 basis point spread. But because that risky asset requires capital, so you just put this big stinky number in the denominator. So 500 bips divided by this big number, and that's what they're being rated on. So while they make 500 bips, the return on capital is poor, right? And so they conserve that liquidity for their top clients who do other things for them, right? And this has really pushed all of this lending into private credit, right? So the banks don't want to lose private credit like they have, but they can't because of Basel and Frank. They can't participate anymore. Vaults unlock their ability to participate. Right. So think of a place where Barclays, my old shop, creates a vault where whitelisted, KYC'd, all that, where their clients and other users can deposit stablecoins for a yield, and then Barclays can use that stablecoins to lend against different types of assets of their clients. So now they're not going to be able to raise it 4% like they can do. So their profit margin shrinks, but their denominator goes to zero, right? So while what that also does is that their headline revenue can go up because they can do more of these trades. They're no longer constricted. They can compete with private credit again. So they'll make less money per transaction, but more money in aggregate and reduce their capital. That's the big reason why banks are getting it enforced. Now, I would say 20% of banks understand what a vault is. So like there's a lot of FOMO and lack of understanding that we're working through. But, I only do institutional stuff when I understand the true value to the institutions. Like I'm not in it for a headline. I'm not in it for, helping a use case that doesn't make a ton of sense just to get publicity. So this is something that is close to my heart, and I understand the bank's challenges. On the asset management side, all these asset managers want to add utility to their existing ETFs and funds, and they believe tokenization is the path.
Yes.
So let's talk about what the utility is. If you're BlackRock and you have the biggest S&P 500 ETF, if you were able to allow clients to put that ETF into a vault and borrow dollars against it, I mean, think about how much the S&P is up in the last 5 or 6 years, right? If you could basically put your tokenized version of BlackRock S&P ETF into a vault, borrow dollars at 5 or 6%, that's cheaper than student loans. That's cheaper than some mortgages, and it's definitely cheaper than credit cards, right? So basically taking their existing stack and then adding a utility layer that doesn't come, because asset managers don't have balance sheets. They can't lend. And the banks don't want to lend against these assets either because of their constraints on capital. So think about how much more attractive an asset is that you can always use for collateral to borrow for things you may need in life, right? That's one. The other thing they can do is, as that market evolves, they can generate yield on those assets in DeFi. Deploy S&P 500 fund, borrow a cheap stable, deploy it into a higher yielding Sentora strategy, and you can now earn a coupon. And that's why we moved into the product called STEY, Sentora Equity Yields, right? So the idea here is we can do this now. And that's why we launched with Ondo, with Xstocks on Euler and Morpho, is we want to give people, one, the ability to borrow against their stocks, and two, the ability to earn yield on stocks that don't have natural yield. So think of high growth companies like Tesla and still being able to earn 3 or 4%. Right? That totally changes the dynamics of asset management in the future. So that's why, and at the base of it is vault curation, right? You haven't heard me say once something about Bitcoin or yield like stable coins. This is what adoption looks like, right? I've always said that DeFi is the future of financial rails, just built on shaky assets. Now the real assets are coming in, and that's the wave of the future, in my view.
So when we're talking here, we're talking about tokenized assets and equities essentially, and basically, just being able to do a lot more with those equities at an institutional layer. So unlocking the biggest form of liquidity and assets that can possibly be unlocked here. Tell me where the experience comes in then. Is there, from your experience now with Sentora, with your experience previously at these traditional banks, which of these two products are you, I don't know if excited is the right word, but which one do you feel is going to see faster adoption? Is it going to be the tokenized equities? Is it going to be the vaults?
It's gonna be tokenized equities, but the vaults are going to unlock that, right?
Right. So it's sort of symbiotic.
So this time last year, so I've always deployed a significant amount of my own wealth in DeFi on my own.
Yes.
Right. I've been asking Jesus for the smart yields contracts, but he keeps ignoring me. Anyway, so I still do it on my own. And last year, around this time, I was yielding something between 15 to 18% on my money.
Wow.
So I'm a client of Morgan Stanley. I went to Morgan Stanley and said, hey, you have all my equities, my 401k, everything else. I want to borrow some money and take it off platform, and I'm going to deploy it in DeFi. And they said, great, 50 LTV, 11%. I was like, you have my assets and you 11%. Like in trading, we have a good price, a price that you don't mind missing at, a price that you miss at to be respectful, and then the go F yourself price. 11% is the go F yourself. And I'm like, I've been a client for like 10 years, like this. He goes, listen, it's not like we don't want to make this loan to you, right? And we can give it to you a lot cheaper if you want to use it as credit to trade more on our platform. But once we send a loan that leaves the bank, we have to put capital up against it, right? This capital theme keeps coming back, right? So it's not like they don't want to service me. They can't. So then I did, so that made me, this got me into this whole idea. And then I realized there's 63 trillion of US equities. 40% is owned by retail. 40. I think Nvidia is almost 40% owned by retail. Right? Wow. So if you think about the growth of Nvidia over the last 3 years, it's like 1,000%. So if you put 10K into Nvidia 3 years ago, you now have $100,000, right? And if you have $100,000 and you have a credit card bill you're paying 25% on, wouldn't it be great to borrow 20K against that and just pay down some debt? Like, that is not offered at scale in retail. I think that's transformational for retail, yes. Right? And I think the crypto exchanges like Kraken, who have both the equities piece and the crypto piece and the tokenization leg and the blockchain, are really positioned for this, right? Robinhood can be a strong competitor in the space. Coinbase can be a strong competitor in the space. But honestly, guys like Schwab are probably going to have to do this to compete if this happens at scale. And if I think about the ability to unlock $25 trillion of leverage, I mean, we could have a whole new economic boom just based, even on a very low LTV. If people could start borrowing 25% of their equity positions in cash, think about what that does to construction, the housing market, consumption, right? And reducing other higher debts. I just think it's such a big outcome that almost everything else pales in comparison.
Yeah, look, that's the 11%. I'm still trying to wrap my brain around that, but obviously it completely makes sense in the broader context of the conversation we've had today. So I love that you've been able to tie that in so well. I think, look, we've talked past, present, and future, and how quickly these things are going to be adopted. Can you give me a timeline for, where you feel this is going to happen, and for Sentora when it's going to happen? We're talking weeks, months, years, and maybe just tell me about that whole timeline.
So while I'm super excited about the traditional inclusion into the space and coming in earnest, there is still a blocker. So we think the Sentora equity play is positioned properly. We also are very bullish on asset managers and their vault creation of product utility. And the third thing we're super bullish on is neobanks and fintechs disrupting the fiat bank account with treasury yields to, stablecoin wallets with DeFi yields, right? I think for traditional people, the fear of hacks and exploits is much larger than the reality. But when you're a Web2 or a traditional bank and you're offering a product, the risk of total loss without any warning that's career risk for people. And people and big institutions don't like to take career risk. So this is why we incubated Firelight. So Firelight is the first scalable DeFi insurance. And what it basically does is it posts collateral against DeFi vaults. So we're not going to, there's others in the space who try to protect strategies or protect individual protocols. We want to protect vaults. Right. So the idea is that you construct a vault, whether it's Sentora or Gauntlet or Steakhouse, and you do it for a fintech or a bank, and they need this protection, right? They cannot have the risk of losing total client funds. So they would come and purchase insurance. Once that insurance is purchased, we post collateral, right? So in an insurance company, you've got a government guarantee and regulations to say they're always going to have enough cash. Yeah. In this, you don't have to do any of that. You can see the position against your position, right? You could see the collateral. If a claim happens, you sell it. I'm oversimplifying it, but I really think two things. One, it's incubated by Sentora, but we're in the final rounds of a fundraise, and it's going to be completely independent. Anybody who makes a decision on claims will be an external counterparty. Sentora will have no insight or no view or vote in claims being adjudicated. And we want to make this a public utility. I think this is not for the 90 billion of DeFi now. This is for the next 300 billion that's coming in. So I think that for us is a big strategic unlock. And I think all these things we talked about just start happening at scale once we're able to launch that.
Yeah,
You like the you like the way I kind of inserted that plug into the into the conversation.
expert level. You know, I've done 1,000 of these, like
Yeah.
not even trying to exaggerate, like quite literally 1,000 of these, and that was very well done. Look, I honestly, I just think the way you guys are thinking about this, you understand it, or I understand it now because of the context you've given me. You know, when you had Into the Block and you had tried and you realize that you basically were just providing these two separate layers and you came together. Firelight makes a lot more sense from working backwards, reverse engineering from how you succeeded in the past and saying, okay, what's the next piece?
Well,
Insurance.
neither of us could have done that on our own.
Yeah.
Right? We've both been thinking about it in isolation, but until we merged the company, and that's why we're so bullish on ourselves, is because that's the first thing we came up with while we merged, while we fundraised, while we, you know what I'm saying? And. So, for us, it's about the next innovation that we're going to come up with that I think we're uniquely positioned to do because of the range of talent that we have.
Yeah, incredible stuff. And Anthony, I can't thank you enough for your time today. It's been fascinating for me, for our audience. I hope you guys have enjoyed this. Whole thing's recorded, get the likes, retweets out. Honestly, I think people need to hear this and understand conceptually what Sentora are building here, because it just, I think, paints the picture of where the future of a lot of this space is going in a really, really detailed way with context that even I understand, and I'm not finance first, you know. So yeah, no, great conversation, Anthony. Thank you again for your time, and unfortunately, that is all we have time for. So we'll hopefully catch you guys on the next one. Hope you enjoyed it. Thank
Thanks,
you.
Jack. Appreciate it.